This recording we're going to look at an IAS1 revision question, Baker Plc. So again, make sure you read the requirement initially because you're going to have these questions in terms of your exam, so it's important to practice your exam technique. First thing, always read the requirements. So you have to prepare the relevant journal entries for notes 1 to 12 where required. And then you're asked for 3 statements: statement of profit and loss and other comprehensive income, statement of financial position, and statement of changes in equity. So initially we're going to focus on the journal entries, but again, it's good practice. You need to read the whole question before you jump into the journals, because there can be links between notes that you can miss if you go straight into it. So I always tell students, make sure you look at the trial balance just to note and highlight maybe any unusual things. So we see here we have 4 non-current assets. Goodwill, which you'll come across in your further studies, that's an asset as well, it's a non-current asset. But then we've only 3 accumulated depreciation lines, because of course we know land is never depreciated. And that is the accumulated depreciation at the start of the year. So you can watch your dates as you go through. You have your opening inventory. This bad debt allowance will be an opening bad debt allowance, because you'll have a closing one. Then bad debt allowance, another word, is bad debt provision. They're the same things. Your bank, if you want to highlight it, your bank is a credit balance. That means it's an overdraft. Corporation tax, we have a credit balance. Your ordinary share capital, that's opening retained earnings at the start of the year. Just looking for key things in case you make a mistake at the end. Then you have all expenses that go down along. Dividend paid. So you might label that statement of changes in equity, because we know dividends do not go into the income statement. They always go to the statement of changes in equity. Rent received, which will be other income. And in this unusual line, a credit for disposal of a vehicle. So you know you're going to highlight that doesn't look right. That's not really how we count for disposal of a motor vehicle. So we're probably going to see that in the notes. But it's no harm to just do a quick eyeball test of the trial balance to see is there anything unusual that you might have to come back to when you look at the notes. Likewise, what you want to do is work quickly down through each of the notes just to see is there any links between them. So land is revalued at the end of the year. So we know how we're going to do our debit and credit for that. And they tell us how to charge depreciation for each of the assets. What you'll notice here is notes 2, 3 and 4 are all linked together, because you can't charge depreciation on motor vehicles until you deal with the disposal in the motor vehicle, because they impact on your calculation. So if you did note 2 and then came back and did note 3, you would have realized you have to redo note 2. So note 3, note 2, 3 and 4 all have to be done together. So I draw a link between those to say they're linked, because it tells you where depreciation has to go as well. So make sure you read through it initially. They tell us closing inventory not at the year end, but 2 or 3 days after the year end. And they give us further information about how to get back to the year end. This is something what we call a rollback. We are rolling back from the 2nd of January to the end of the year. Right, so we'll have to work through those adjustments. Note 6 says we have a share issue which wasn't accounted for. Note 7 is a normal bad debt and a new allowance at the end of the year. So quite a predictable working. We have a bit more complex of a working in Note 8, which deals with rent, including rent expense and possibly rent prepaid at the end of the year. Then you have a normal corporation tax adjustment, Note 9. And then Note 10, 11 and Note 10 and 11 are just about presentation in terms of splitting out your expenses between distribution, finance costs and admin costs. And then we have an adjustment for dividends paid during the year, but also a dividend proposed at the end of the year. So it's it'll only take a small few minutes to work through each note, but just have an idea of what are the adjustments that are coming up. And the main reason I want you to read through all of those notes here was for looking at the link between 2, 3 and 4. Because if you didn't read through those notes, you would have ploughed on with note 2. You'd have to redo a lot of your working for note 3 and note 4, because they're all linked together. So watch out for that in exam questions. Just do a quick high-level view of all the question first before you start into it. Now, before we start our journal entries, I think it's always a good practice if you leave your first couple of pages for your finished financial statements. Some students even set up the template and have it ready to go. So for example here, I have left, this is just in Excel, I've left a different page for my template. It'll always look the same. It's always the same line items for your statement of profit or loss. Statement of financial position, you might know all the headings. Now I have them in here just for ease of the recording, but you'll still have non-current assets, current assets, equity. So just leave a couple of lines between each. And generally what I would do is 1 page for your profit or loss account, 2 pages for your statement of financial position, and 1 page for your changes in equity. And you will practice that throughout the year, and you'll probably get a bit more savvy then in terms of as you finish with things, you might slot them in as you go along. Now we'll leave it till the end here just to make it easier that we're not flipping between tabs. But to try and practice yourself, if I finish with depreciation and assets, can I put them in and get it finished with? Because remember, there are marks going for finished financial statements. So leave your first 4 pages here for your financial statements. Some of you may want to start out a template, so you can slot them in as you go. And then after that, your workings can take as long as they want. And we're going to start with working 1, which is going to be on our land revaluation. And we'll take it working by working then. And a good student will cross-reference those workings in then as you are finishing your financial statements. So it's a lot of it is about exam technique as well as your technical accounting knowledge. So your total land here is revalued at the end of the year to 300. It's currently in at 120. Now this is a nice straightforward revaluation under IAS 16. Why? Because there's no depreciation. Land is not depreciated. So you just debit your land to increase the asset and you will credit your reval reserve. And that will go through OCI. That will go through other comprehensive income in your statement of profit or loss. So that's going to be a 180 revaluation gain. Now you might want to slot in land straight away because you know it's now at 300, or we'll wait till the end. So that's personal preference, how you want to remember all of those things as you go through. So that's our first journal complete, and we can call that a working as well. But remember now, land is going to be at 300 in the statement of financial position. Next one is depreciation for buildings, equipment and motor vehicles. And remember now, these are linked together because there's a disposal of a motor vehicle, so we need to watch for that when we're doing our depreciation. So we have buildings, we have equipment, and we have MV, motor vehicles. Your buildings are going to be 4% straight line, so that's on cost, 4% to 250. So that's going to be 10,000. And so you notice here, they're dropping the last 3 zeros, so we do the same. There's no need to put in extra numbers. It's just going to take up a lot longer to do in the exam. You're not going to get marked down for it. Equipment, now be careful, is 40% reducing balance. So that means it's 40% of net book value, which is 196 minus your accumulated depreciation. 196 minus 76 times 0.4. So that means it is 120 times 40%. So your depreciation for equipment is 48. Right. And finally, then your motor vehicle, it's 25% straight line. Where a lot of students get caught here is they will do 25% of the 284. But remember, we have a disposal during the year and you're told no depreciation in the year of disposal. So there's a kind of a tricky one. There's a link between note 2 and note 3. So it's actually going to be 284 minus 44 because that's the cost of the asset you disposed of. So it's going to be 25% of 240. So your depreciation for motor vehicles is 60. So the overall depreciation then for the year 2016 is 118. And remember now, we're linked to note 4 as well. That's actually going to be split between distribution and admin expenses. So we don't show each line item now. We put into 2 buckets of expenses, and we'll just do it here for clarity, into DC, distribution costs, and AE, admin expenses. So buildings are 5 and 5, 50% split each. Distribution costs here are 12 and 36, 1/4 and 3/4. And then motor vehicles will be 42 and 18, which is 70/30. So the total distribution cost of 59, and it's just coincidence that the total going to admin expenses is 59 as well. So, but there is a bit of work there, and it's important that you get the labeling right because that's going towards your presentation marks. IAS 1, the standard for financial statements, says you must look at distribution costs and admin expenses. So there's a link there, and you have to be savvy in terms of doing that all together to make it a bit easier on yourself. So what are your debits and credits then? Well, we're going to do overall debits and credits. You're going to debit your distribution costs. You're going to debit that 59. You're going to debit your admin expenses, 59 as well, because they are the two splits. So we're just trying to be easier, not to try and do 7 or 8 different journals, just summarize them and add them up. Then you've credit accumulated depreciation, buildings, credit accumulated depreciation, I'll just put that for equipment, E, and then credit accumulated depreciation for motor vehicles. So we can't really add those together because they're 3 separate items, and we're going to have to look at them separately. 10, 48, and 60. So you have 118 on the debit side, and you have 118 on the credit side. So again, but what you have to remember now, you're given the journals, but when you're preparing the financial statements, these will have to go in as well. So whatever way you track your workings, you have to get a bit more savvy at that, particularly in terms of your time management. So that brings us on then to working 3. So we actually have to do our working for the disposal as well, because all we've done is account for it for depreciation. But what we're told is we sold a vehicle for 10 grand. Sales proceeds were they debited bank, but they credited this disposal account. So you can draw a line there. That's where the 10 comes from. They debited bank and credited this, but we know that's not right. We know you should remove the asset and recognize a profit or loss on disposal. Right? So what we need to know is the net book value at disposal. Right? How we get that is the cost, 44, minus your accumulated depreciation. Now, they don't tell you accumulated depreciation, but if we know what the motor vehicle policy is, we can figure it out. Full year depreciation in the year of acquisition, so full year in 2013, full year in 14, and full year in 15. So it's 3 years depreciation. And depreciation is a quarter a year, 25%. So you're charging 11,000. So it's 11 times 3. So your net book value there is 44 of cost minus 33, which is your accumulated depreciation. So your net book value is 11 and you sell for 10. So that is a loss on disposal. And that is going to be 1. So you can do your calculation out initially. And we still have to give journal entries, but it's important to do it out because you'll know whether you're right or wrong doing your journals. So it shouldn't have been just credit there in this thing called disposal of vehicle. It should have been, what we're going to do here is, you're going to debit accumulated depreciation, motor vehicles. You're saying remove 33, which is the accumulated depreciation of that asset. Because if that asset is gone now, it should be removed. We're going to debit disposal account, 10. That is removing this 10 here. It shouldn't be there on its own account. That's not how we account for disposal under IAS 16. You're going to debit loss on disposal, which is an expense. Tidy up that. That's going to be 1. And then you're going to credit your motor vehicle cost account. Because if the asset is sold, the 44 should be removed as well. So you have 44 on your credit side, 44 on your debit side. But that's important that you understand exactly how to deal with the disposal of a non-current asset, which would have been covered in AF1. And so there's your debits and credits, and all these will have to go into our financial statements in some way, shape or form. So that's moving us on to working 5, or working 4 should I say, which is note 5. So working 4, so just label them clearly, just so the examiner can follow. We're told here closing inventory, which is covered in IAS 2, at the 2nd of January in the new year was 119. So we'll say closing inventory was 119. However, that's 2 years after the year end. That's not the figure we want. So this is quite a tricky working. What we're trying to do is roll back and figure out, well, if we know what was there 2 days after the year end, and we can figure out how much we purchased in those 2 days and how much we sold in those 2 days, we can work back, or what we call roll back, to the 31st of December 2016. So we're told here during that period of 2 days, goods were sold for 8,000 and it sets its price cost plus 60%. Now these sales were in the new year, so they should be in the accounts for the new year, which they are. So that's fine. Those sales should not be in 2016 accounts because they're made in 2017. However, those goods are not in this 119. But if they were sold after the year end, they should have been in the inventory at the 31st of December. So we're now going to add back, we're going to add in these amounts. Now be careful, we don't value inventory at their sales price. We value inventory at cost. So if it was sold for 8,000, that is 160% of cost, because you're adding on 60% when you're charging your price. So the cost of that inventory is divided by 1.6, which is 5. Right? Because remember, we're dropping the last 3 zeros. So that's a tricky one. We're saying if it was sold after the year end, that means it was there at the year end. So when we're reconciling back, the 119 does not include that inventory that was sold during those 2 or 3 days. And vice versa then, you're taking off purchases that happened after the year end. So these purchases, 11,000, they're in the 119, but they were delivered on the 2nd of January 2017. So they were never there at the 31st of December. So you're going to minus 11 there. So that's the tricky one when you're rolling back, but you're trying to figure out what was there at the 31st of December 2016. And that's already a cost, so you don't need to adjust. There's also an inventory amount of 8.2, which was sold in a clearance sale for 6.2. So we're going to have here what's called a write-down. Under IAS2, inventory should be measured at the lower of cost, which is 8.2, and net realizable value. So we're assuming here that the sales price in January is indicative of what the net realizable value was at the year end. So that inventory shouldn't have been in there at 8.2. It should be in there at 6. So you're going to minus there 2.2. So just minus that out. Short. And that means your inventory, closing inventory, that's technically going to be, I think, 110.8. That's your closing inventory at the 31st of December 2016. So that's the one that you're going to put as an adjustment in. So that was quite tricky now. It was an exam standard one where you're rolling back from after the year end, which can happen when you may not be able to attend the stock take at the 31st of December. So your debit there is inventory, which is a current asset, and you credit your cost of sales, 110.8. 110.8. So just tidy up those because the point to show the 0.8. Right, so that's under, if you want to reference there, IAS2, International Accounting Standard 2, which covers inventory. So that brings us on then to working 5 as we've labelled them. And this is to do with a share issue during the year has not been incorporated into the books. So again, you're going to get debit bank, the amount of money. Your raised shares, 10,000 shares of 150 each, is 15,000. So we're dropping the last 3 zeros. You're going to credit ordinary share capital. You always credit ordinary share capital just the nominal value. So 10 times €1. That's the nominal value of each share. And the difference then you're going to credit share premium, which is the 5. So you always put the share premium account, the amount that you issued for, over the nominal value. So the 150 is the market value, the €1 is the nominal value. And a good student here will label this SOCE. So they'll remind you that that's going to be an adjustment in your statement of changes in equity, because we have to do that statement as well. So try and make your life easy that when you're going back over at the end, you have your labels or your different colour biros to remind you where everything goes. Or some students will slot them in as they go along, so they don't have to go back over everything at the end to finish off the question. Working 6 then is our trade receivables and our bad debts. We have a bad debt to be written off of 8,000, so that's a traditional type adjustment. Debit bad debt expense and credit trade receivables. Because it's a bad debt, it's directly credit to trade receivables, 8 and 8. However, what we also have in here is when the allowance must be adjusted to 4% of the remaining receivables, which is a key word. That allowance can also be called a provision. So the old allowance, and remember we labelled this already, the old allowance at the start of the year, which is carried forward from last year, is 8. And the new allowance, you're told, must be 4% of the remaining receivables. Receivables currently, if you look down here, are 183. The debit is the asset receivables, but we have to take off 8 because we know 8 of those have been written off. So you always take off your bad debt first, 183 minus 8 times 4%. So that's going to be 183 minus 8 times 0.04, which is 7. So your new allowance there is a reduction. You want to say reduction in the allowance of 1. Let's just So that's a reduction. So you say you want your new allowance wants to be 1 lower. So how we reduce the allowance? We're reducing a credit balance. You debit the bad debt allowance. You debit it by 1. That is debiting a credit balance. So it's going to go from 8 down to 7. And this is a good movement, a reduction. So you're going to credit your bad debt expense of 1. Crediting the expense is reducing it. Right? So again, that's a common enough adjustment in these is dealing with normal bad debts, but also then dealing with bad debt allowance, or what's also known as a bad debt provision. But there's marks going for each one, and you are asked as a journalist, so you need to give clear journals. And look at they're clearly labelled as well as you go down along. Working 7 then, for us, which is note 8, is to do with your rent. So you're told here the rent premise from local landlord. Rent is charged 18,000 and the main expenses. This is paid quarterly in arrears. So they've done 3 payments so far. 31st of March, 2nd of July and 4th of October. And they renegotiated the rent and has now increased the annual rent to 22,000 commencing on the 1st of January. So you also requested the future payments will be in advance. So the new structure will be in advance. And on 31st of December, the business paid 10,000 to the landlord. So if we go up, I don't know if we can see rent here. They don't show rent exactly, so we can't split it out in terms of the trial balance. But what we're told here is they've now made 2 payments at the 31st of December. So if we look at the 31st of December payment of 10,000, it was paid 10,000. That's made up of 2 things. You have to read it carefully. It's made up of quarter 4 rent for 2016. That's in arrears, and they paid 4,500. So we know they paid at the end of March, end of July, end of October, but there's 1 payment left because it's 18,000 for the year, and that'll be 4.5 at the end of December because you pay at the end of each quarter. But there's also, they changed the structure then at the end of 16 and said, well, for 17 onwards, you're going to have to pay in advance. So you pay in December for the following January, February and March. So your quarter 1 rent, 2017, was going to be 22,000 divided by 4. So 22 divided by 4, which in this case is 5,500. So that's where your 10,000 comes out of. They've paid their normal rent, which is fine, and that's expensed. There's no problem with that. That's the rent for 2016. But what they've also done here is they've done 5,500, and they've expensed that as well. Now that's actually not an expense for 16. That's a prepayment for 17. So the entry there that would have happened would have been credit bank, debit rent expense. But technically that 5,500 should be debit prepayment, which is a current asset, and credit rent expense. And we're doing 5.5. So remember here, we're doing in thousands. So we're dropping the last 3 zeros. So you can do full numbers if you want, but it just takes a bit longer and there's no real value to it either. So you debit your prepayment and you're going to credit your rent expense, reducing the expense, increasing your current assets. So that was tricky the way it was worded. You try and think through how do the 2 rent agreements work together? Where does the 10,000 come out of? Quite a tricky one, but an exam level one. So working 8 then, we're looking at corporation tax. Now again, this is a bit of a tricky one. You're told corporation tax for December 15 was overestimated by 6. And hopefully you remember when you look up here, that's where this 6 balance comes from, corporation tax. So what they mean there is every year you will estimate what your tax bill is. Only after the year end then, when the tax deadline happens, you'll know your exact bill. So what happened last year was you estimated 6 higher than there was needed. So when you paid off your tax bill, you had 6 of a credit left in your account. So that's a legacy issue. So what we're allowed to do in tax is say, if we overestimated last year, we can reduce our expense this year. Because again, if you overestimated last year, your expense was too high last year. So what you're allowed to do is reduce your tax expense this year to offset it. This is a particular rule in the tax. So what you're allowed to do is debit your tax liability, 6, that removes the liability. And what you're allowed to do then is credit your tax expense. To say, I over-expensed last year, So instead of going back and rectifying last year's accounts, you're just allowed to reduce your expenses for this year. So that's a tricky one, but watch for when you have an opening balance as a credit or debit in the tax. That may be for under or overestimate from last year. And you're told the estimate for this year's tax then is 30. So what we would usually do is debit your tax expense and credit your tax liability. So we're saying 30 here and 30. But what I want you to look at the net difference. Your tax expense now is actually only going to be 24. Why? Because 6 of that you expensed last year and there was no need. So they're saying you don't need to expense it again this year. So the accounting rules, you won't have covered this yet, but it's IAS 12, which covers tax, allows you to adjust current year tax expense for any prior year over or under estimates. So it's a tricky one to watch in the future. So for note 10 then, 1/4 of wages and salaries are paid to distribution staff and the remaining is to admin staff. Now we will do that in a separate working, just splitting it out. There's not really a debit and credit there. That's merely for presentation purposes. So our wages and salaries up here, 276. We're going to split 1/4, 3/4. Same with admin expenses. Overdraft interest shouldn't be classified in admin expenses. So we're going to take 9,000 out of there and call it a finance cost. So you can do a journal if you want. Not really required. It's more about presentation, the financial statements. And the last one then, which is the dividend. So a dividend of 10 cents per ordinary share was paid on the 30th of June. So just go up and double check. We have a dividend in there of 21. So that must mean it was already accounted for in terms of your dividend. So that 21, if you want to think about, comes from, we have 200,000 ordinary shares originally. And remember, be careful, we issued another 10,000 in February. If the dividend wasn't paid till June, that means there was 210,000 ordinary shares at 10 cents each. That's where the 21,000 comes from. So you should have realized that is already in the trial balance. You don't need to give an adjustment again. And lastly, the directors proposed a final dividend after the year end. In accounting, you are not allowed to account for a dividend if it was proposed after the year end. So all we'd expect you to write there is no adjustment required for dividend as it's proposed after the year end. Now it's a bit of an advanced one, but they're the exam standard ones you have to watch out for, and more practice of IAS 1 questions will get you where you need to be. So for 10 and 11, they're more presentation issues, and for 12, it's already accounted for the normal dividend paid during the year, and at the end of the year, that is not allowed because it was only proposed in 2017. So typically then, before we go on to our financial statements, we have 2 more workings we do. We do our expense table, splitting admin expenses, distribution costs, so we have the figures, and we also do a property, plant and equipment working, just so we have it all as a single figure before we do our financial statements. So we're going to do working 9 then, an expense summary. We're going to try and get a single figure for distribution costs and a single figure for admin expenses. So it's good practice to do this as the working because there can often be a lot of expenses going in here, and it's good discipline to work down through your trial balance and slot them in as you go along, because often students will end up leaving things out and then by default losing marks. So if you look down here for any expenses, we have director's fees 150. So we'll slot that in as an admin expense. Director's fees, we put there 150. Sometimes it could be subjective, and that's fine. You're not going to lose too many marks. Wages and salaries, hopefully you've already flagged. There's a note there. Wages and salaries, 1/4 goes to distribution, 3/4 to admin. So wages and salaries in total is 276. W&S, 276 divided by 4, 69 goes to distribution, 274 times 0.75. And 206 goes to admin expenses. Now I think they might be rounded a small bit. 205. So 276 times 0.25. So I think they might be slightly rounded. So if you round them as well, that's fine. It's technically 69,205.5. So I double check. That should be 276. So both them 207 and 69. So there's no rounding, it's just my error. That's 3/4. That's coming if you want to put there. That's coming from note 10, just to show the examiner. Then going down along the trial balance, distribution costs, I'd put in brackets there the TB, that is 101. Admin expenses in the TB, that is 186. We'll just go down here just in case. We're told here admin expenses includes bank overdraft interest of 9. So just be careful there. Overdraft interest, note 11. What you're going to do there is minus 9. And we're going to call this finance costs, and we'll put 9 there. That's just to show that actually 9 of that 186 is not technically admin. It is a finance cost, so it should be shown separately. And so that's what your first approach is. Go down through the trial balance, identify each of the expenses, and tick them off as you put them in. Because when you're exam pressure, you can easily miss one. And what we'll do then is we'll do the same for the workings. We come back up, working 2, there's none in working 1, working 2, 59 in both expenses. Just put there, I just put working 2, depreciation, 59, 59. So you can see they're nice and neat, and you're cross-referencing to show the examiner where your workings are coming from. There's nothing more frustrating for an examiner that a student doesn't show where figures come from, and therefore we can't reward you the marks. So working 3, we have a loss on disposal of 1, which we'll put into admin expenses. So working 3, loss on disposal. So it's a bit subjective. I'm putting into admin expenses of 1, and that's an expense, so it's going to increase it. So keep going down along. Working 4, no adjustment to expenses, none in working 5. Working 6 then, you have bad debts of 8, and you have a reduction of 1. So working 6 has 2. Working 6, bad debt. Working 6, bad debt allowance. And again, subjective where you put them, you can put them in either one. In this case, to be consistent with solution, we'll put them in distribution costs. That's going to be an 8, and again, that's going to be a minus 1, because you're crediting the expense. What that means is you're reducing the expense. So that's working 6. Working 7 then, you have credit the rent expense, 5.5. And therefore, that's working 7. Rent prepaid. That is going to be in admin expenses minus 5.5. So I just open that out so people can see it's a decimal. So you've referenced there working 7, and then working 8, that's to do with the tax. It's nothing to do with the other expenses. So we have our first summary done then, and all you do is add them up. And that's nice and neat then. And you're just going to be putting in those figures. Just double check, bring that 150 as well. And that's going to be 9. And just make sure, because there should be a half in here, just so we won't lead students astray. They're the 3 figures you're going to slot in. And the benefit of that is you're going to have a very neat statement of profit and loss. And you just reference working 9 for each one. So it does speed up things a lot. And as you get more savvy in these questions, you can actually have this expense summary set up at the very start. Some students have this as working 1 and slot in their adjustments as they go. So you don't have to go back over like I've done. But the more questions you do, you will pick up these time-saving tips as you go along. Similarly then, working 10, we're going to look at PPE summary. Because instead of trying to do all the workings on the face of the financial statements, we're just going to look at them in total here. So we're going to look at land, we're going to look at buildings, we're going to look at equipment, and we're going to look at motor vehicles. Right? And you're going to look at here cost and accumulated depreciation, and that gets your net book value. And so some of them will have adjustments, some of them won't. So the cost for land, now be careful here, this is now 300. So reference there, working 1. You had 120. Now technically it's not cost, you can call it revalued amount. There's no depreciation on land, so your net book value is 300. And a good student will cross-reference the working to make it easier. Buildings, we have from working 2. The cost hasn't changed, it's going to be 250. Be careful now, you've accumulated depreciation of 90, which is coming from here at the start of the year, but you also have more depreciation of 10 during the year. So you have 100 depreciation accumulated overall. So that means it's going to be 150 of a closing net book value. So I'm just referencing working 2. That comes from 90, opening, and the current year. Same with equipment. Working 2. Opening is 196. Accumulated depreciation 76 opening, and another 48 during the year. So 124. So your closing balance, then your net book value for equipment is 72. So nice and neat, and you're showing the examiner where the figures are coming from. Finally, then motor vehicles is working 2 and it's working 3 because you have disposal as well, remember. And be careful here. It's going to be here 284 minus 44. Because remember, we've taken off the disposal. We credited your motor vehicle cost 44. Right, so this is a tricky one. Accumulated depreciation has an opening 132, which is coming from here. However, you want to add back 33. That adding back 33 is the removal of the disposed amount of accumulated depreciation. By debiting a credit balance here, which we're doing, we're removing it. And then we're adding on depreciation for the year of 60. There's a couple of moving parts there that you have to watch for minus 60. So it's the opening balance, remove the disposal adjustment, and add on the depreciation for the year. So that gets you 159, and your closing net book value, adjusting for the disposal, is 81. And we then have a single figure for PPE, 603. And we can cross-reference then working 10 in to make it a bit easier in terms of presentation. So there's a bit of work there going down to your adjustments, but it's important to be neat, because the neater you are there, the more summaries you've done. When you come to your financial statements, finishing them off, it can be quite straightforward. So once we've all our adjustments done, then it's a matter of going to your financial statements and filling it in and finishing it off. And hopefully then if you've done everything correctly and you've ticked everything to make sure everything's included, you should get a balancing statements. Now remember, some students might have set these up at the start. You should have left one full page in your book at the start for P&L, 2 pages for statement of financial position, and 1 page for statement of changes in equity. Some students like to set up a template and just leave a couple of extra lines for something you mightn't have seen in other questions. Other students prefer to leave it till the end. It's entirely personal preference, but what we want to see is a nice neat one, and you'll have a lot of your workings done already. So for example here, your revenue, you're getting sales here 1432. Right, so in that regard, there's not much else you have to put in. Some students might want to put here just a little note, TB. So in that regard, it's coming from the trial balance, but some students just leave it blank, and if there's no adjustment, you can just put in the figure straight away. Just tidy up these. So cost of sales, then we have 3 figures to put in. We have your opening inventory, which are given here, of 107, plus your purchases, which are 488, minus your closing inventory, which we have from working 3, I think, 110.8. You might just put in there in brackets the working, and closing inventory is actually working 4. So for small little workings like that, it might be useful just to show them as a little column there. But for the bigger ones like distribution admin, you wouldn't fit them there. So it's probably just best to put them as a separate working and just cross-reference in. So here, minus brackets 107 plus 488 minus 110.8 gets me to minus 484.2, and your gross profit is 947.8. So it's not much to that, but it's just important to practice, and particularly your layout, showing the examiner where figures come from. Because if we can't see where they come from, you won't get your marks. Other income, we didn't come across any other income in our workings. So always just eyeball your credit side here. And the only one that sticks out there is 30 for your rent. So put 30 there for other income for rent received. And again, I would tick that off if you had a pen and paper, just to make sure that's dealt with. Don't worry about it again. Distribution costs, we have both of those done. So if we go back to our sheet 1, working 9, that's 236 and 588.5. So working 9 minus 236, working 9 minus 588.5. You can see here, nice and neat. The examiner can see where they're coming from. And then our finance costs are working 9 as well, minus 9. So you add all of them up, that will get you your profit before tax, which is 144.3. So if you do a good job on your workings, your actual finishing the financial statements shouldn't take that long. Your income tax then, go back to your workings. We have working 8. Now be careful. You have 2. You have credit tax expense and a debit the tax expense. So the net expense there is 24. So working 8, you want to reference minus 24, and your profit after tax will be 120.3. So your profit for the year is 120.3. Now that's where most students would have stopped, but remember, this is the statement of profit and loss and other comprehensive income. So you actually have one element of other comprehensive income here. You have a land reval gain. And we know from working 1, that is 180. So you have to make sure you realize that you can have other comprehensive income, and adding that to the profit gets you total comprehensive income of 300.3. So that's a key thing to watch out for. A lot of students forget. Watch when your template is done. Have I any other comprehensive income? You have here in the form of a land revaluation gain. You're not crediting the P&L. You're crediting what we call the revaluation reserve, which goes through OCI, other comprehensive income. That's a tricky one, but a bit of practice should help you along. So there is our statement of profit and loss, which is what you always have to start with. And then we're going on to our statement of financial position, which again should be sped up by the fact that we have some workings done. Working 10 for PPE is 603. We have that done already for your sheet 1. 603 for all of those 4 added together. Now you might have come across goodwill before, but that is also a non-current asset. So we're just taking that from the trial balance, 300. So your non-current assets then are 903. Nice and neat, no messy workings which will lose presentation marks, and the examiner can see where you're coming from. Inventory we have from working 4 is 110.8. Trade receivables, now you need to be careful with trade receivables. We have a couple of adjustments done. So we're starting off with trade receivables 183. We take off our bad debt of 8, and we take off our updated provision, which is now 7. They're all coming from working 6. It's just to remind you of that. We come to working 6. We credit a receivable 8, which is minus 8. And our allowance now, how you present it is your allowance is now gone from 8 to 7. So this figure is now 7 on the credit. We always present the bad debt allowance net of the receivables. So your trade receivable now is technically 175, and then you take off 7 for the bad debt provision. So that will be 175 minus 7, which is 168. That's a tricky one, but show the examiner where you're getting your figures from. Small little calcs can be shown like that. Bigger calcs, you're better off doing it separately. And then you have a working for your rent received, working 7, or rent prepaid, 5.5. So your total current assets are 284.3. Sorry. Just make sure it's neat there. And your total assets are both of them added together, current and non-current, which is 1187.3. So hopefully we can get our bottom half to do that as well. So it's nice and neat. And if you're not sure, just when you're doing your subheadings, leave a couple of lines. You're not going to get docked for empty space. You might get docked if you're trying to squish a load of stuff together and it's not easy to read for the examiner. So the bottom half then, we have our share capital, share premium. These are the usual ones you will see. Share capital, we have 200 from the trial balance plus 10. That is coming from working 5 because we had a share issue during the year. So there's where your 210,000 comes from. Share premium from working 5 because we have no opening share premium. So working 5 there is going to be 5. Revaluation surplus, we didn't have any opening, but we have 180 from our working 1. So when you do your OCI here, that feeds into your revaluation reserve or revaluation surplus in the statement of financial position. And lastly, then your retained earnings, be careful. You're going to have your opening, which is 503. This is always the adjustment, plus your profits. Now, make sure you take the right profit figure. it's 120.3. This reval gain, the 300, this is already put into a separate heading, the 180, so do not double count it. And what comes off retained earnings is the 21. So the dividend paid is never showed in the expenses. It only goes into retained earnings, and it also goes into your statement of changes in equity. So that gets me 503 plus 120.3 minus 21. So closing equity is 997.3. And we're going to use that for our statement of changes in equity in a second. Current liabilities, then you just try and go down and check each one. What have I in? I have a payable here, trade payables of 117. I have a bank overdraft, which we flagged already. It's in here as 58, but remember, if you would have remembered all your adjustments here, we debited bank 15 for working 5. So you can see you're going to need some method of remembering all those adjustments, and that's why some students like to slot them in as they do them, so they won't forget them at the end. So this is going to be 58 minus 15, because money coming into the bank reduces the overdraft. So your bank overdraft is now 43. And your current tax payable, just be careful, we had an opening balance of 6 from our trial balance. In working 8 then, we reduced the liability by 6 and we increased the liability by 30. So that's where some students, so we removed the 6 and we added in 30. So it's 6 minus 6 plus 30. So your closing payable is 30 for tax. Now, some students go wrong there. That means your expense will be 24, but your current tax payable will be 30. So make sure you go back and look at the journal entries there to figure out exactly how we end up in that situation. And that gets us current liabilities of 190. And if we look through the rest of our credit side here, we have no other long-term liability. So what we call non-current. So there's no bank loan or anything like that. So hopefully when we add both of these together, the 190 plus the 997.3, that gets us to our 1187.3. And we know we're correct because they balance. Now that may not always happen when you're doing your exam questions, and that's why I said to remind you, it's always useful to tick off things as you put them through. Tick every item here as it goes in, and tick every adjustment as it goes in as well, because usually what happens when it doesn't balance is students have made a simple error by leaving out 1 or 2 of the adjustments. And of course, if you even leave out 1, your trial balance is not going to balance. So you do your P&L first, then followed by your statement of financial position. And your last one is quite a straightforward one, but students often lose marks in it. It is our statement of changes in equity. So I'll just open up this a small bit to see it. It's done in a different format now than it's a columnar structure. And what you have to reconcile is between opening and closing equity balances. So this is where you start with your closing balances. These come from the statement of financial position. So all we're doing is taking these balances and putting them in the horizontal. Closing share capital is 210. This is 5. This is 180. And the closing retained earnings is 602.3. So there's nothing new here. You've done all this before. That's why you have to do the statement of changes in equity last. You must have everything else done before you look at the movements here. And we're trying to reconcile to our opening balances. And there's 3 movements during the year that we know go into the statement of changes in equity. We made a share issue, which would have put 10 into our share capital and put 5 into our share premium. So you just slot them in as the figures you know. We had dividends during the year, which would have been a minus 21 to retained earnings. So that's how the dividend is presented, as a minus 21 in the retained earnings column. And watch the way the total comprehensive income column is shown. You put the 180 into the reval reserve, and you put the 120.3 into retained earnings. So the total is still 300.3, which matches your total comprehensive income up here, but it goes into 2 different columns, matching the adjustments it goes into in your statement of financial position. So there's nothing new in the statement of changes in equity, but it is a key statement that you need to know. So it's all about practice. So your total there is minus 21, the total there is 15. And the last step always is, what was the opening balance Well, the opening balance here must have been 200. So 200 plus 10 gets me to 210, which matches my question. The opening was 200. The opening here must have been nil, which matches my question, because 0 plus 5 is 5. And likewise here, the opening must have been nil, because 0 plus 180 is 180. And then we can work back. Something plus 120 minus 21 gets me 602.3. So you just work backwards, add back the 21 and take off the 120.3. And you'll usually know if you're right or wrong because it will get back to the opening balance as per our question, which is 503. So these are a nice little statement to get, but it will be worth a significant amount of marks. So don't throw it away by not practicing your statement of changes in equity. And that means my opening equity would have been 703, which matches your trial balance. So that statement is always done last because you need information from the statement of profit and loss and the statement of financial position to actually finish it off. So that was the Baker PLC question, a revision of IAS 1, which should have been hopefully a refresher of your AF1 knowledge.